Good afternoon, everybody, and welcome to today's webinar, The Missing Asset Class in Your Investment Portfolio, Impact Investments, a moderated discussion. We have an exciting panel for you guys today, but before we get into the nitty-gritty, I wanted to review some housekeeping items, introduce our speakers, and tell you a bit about Next Generation. So as always, today's session is being recorded and will be available for on-demand viewing for anybody that didn't have a chance to make it live. If you are here with us live, welcome. You'll be muted for the entirety of the session, but that doesn't mean that we don't want to hear from you. So if you have some time, introduce yourselves in the chat box and feel free to use that feature just to kind of chat amongst yourselves, kind of as we go through today's conversation. If you have any questions, feel free to use that chat box to ask questions. Otherwise, you can refer to your GoToWebinar control panel, which should be on the right-hand side of your screen. There should be a tab that says Q&A. You can field any of your questions there as well. I will attempt to answer, or I should say pose any questions as they come in if they're relevant. Otherwise, we will hold them for the end. Now to introduce our speakers. First, we have one of our co-hosts, John Sand, who is the founder of Impact Investments Consulting. John is a social impact strategist, a philanthropic advisor, and community engagement specialist. John is motivated by challenging work and marketing strategically designed programs which tackle the United Nations Sustainable Development Goals. He has expertise in utilizing charitable giving and insurance strategies, and his other areas of expertise include social impact investing, financial analytical skills, sales and marketing, philanthropic planning strategies, business development, generational philanthropic coaching, impact investing opportunities, and generational wealth transfer strategies. In addition to John, we have our co-host David Sims, who is the managing partner and founder at Talenton LLC. Talenton is a values-driven investment firm where he focuses on opportunities to create jobs, bring hope, and transform lives for people living in poverty in the developing world, with a special focus on East Africa. Talenton mobilizes purpose-driven investment capital through a unique model into a pooled social impact fund where the investments generate scalable, sustainable, and transformational impact by being invested in growth stage companies creating good jobs in the developing world. Investment returns then flow back into the investor's self-directed IRA, donor-advised fund, family foundation, or source of origin, thereby preserving and growing the investor's capital for future investing or giving. Prior to founding Talenton, David served as executive chairman of Opportunity International, a global microfinance organization serving 10 million clients and lending $1.3 billion annually. He has chaired the U.S. Global and Microinsure boards over decades of involvement with Opportunity from when it served fewer than 1,000 families. David's career spans executive roles in financial services, management consulting, government, and nonprofits. He has served as a partner with Bridgespan, SEVP at MBNA America, CEO of the American Red Cross, Washington/Baltimore Blood Services region, and was a White House Fellow. David started his career at Bain. He holds an MBA and JD from Harvard and has earned 2 bachelor's degrees in economics and applied sciences from the University of Pennsylvania, summa cum laude. And last but certainly not least, we have Brittany Melville, our Director of Marketing and Sales. Brittany leads sales and marketing efforts here to promote education on self-directed IRAs and oversees the team responsible for helping investors set up their accounts to make alternative investments, which include real estate, private equity, lending, and more. So now we're going to talk a bit about Next Generation. So Next Generation is a custodian and administrator for self-directed retirement plans, These types of plans are exactly like the ones that you'd find at a brokerage, such as Fidelity or Charles Schwab. However, instead of investing in assets that are publicly traded, such as stocks and bonds, self-directed IRAs allow you to invest in non-publicly traded alternative assets. Our administrative firm and headquarters, Next Generation Services, is located in Roseland, New Jersey, and they provide record keeping and tax reporting for all of our client accounts. Next Generation Trust Company, our sister company, is located and chartered in Sioux Falls, South Dakota, and they provide custodial services for the assets held within our client accounts. So moving on to our very necessary disclaimer on what we don't do. So we're not a bank or a fiduciary. We don't provide any financial, legal, or tax advice. Any information provided in today's webinar is for educational purposes only. So please consult with your trusted professionals to determine if this strategy or investment is the right fit for you and your retirement goals. So with that being said, I'm going to hand the floor over to our moderator, Brittany Melville, who will drive today's conversation. So Britt, take it away.
All right. Thanks, Erica, for the introduction. Thank you, everybody, for spending a piece of your day with us here to talk about a very interesting topic. I don't think we've ever addressed this in any of our sessions previously, but I think it's one that's important, and I think we're going to see a lot more interest in the coming years around impact investing. So thank you to our esteemed panelists for joining us. My bio following David's was just... Don't ever call me after David's bio again. But
that just means I've lived longer than you, Britt. That's all.
That's what I tell myself. Actually, very inspiring. So, thank you for that. So let's jump in and let's just talk about. We'll start with you, David. For anybody with us today that is interested in impact investing, but if you had to ask them, maybe couldn't even define it, you know, what really is impact investing? Help us better understand it conceptually first.
Yeah, Brittany, thanks. Well, thanks. Let me thank you and Erica for just the chance to share with the audience what's going on in impact investing and helping people get educated a bit on this, what we think is an inspiring opportunity to make a difference in the world. And if I turn to our friends at Davos, the World Economic Forum, they actually define impact investing as an investing approach that is intentionally seeking to create both financial returns and social impact that is actually measured. And impact can actually be, investments can actually be made into for-profit or nonprofit, but on the slide, the audience here will see that this blend between for-profit and nonprofit meets in the middle in an impact company that is intentionally trying to do good in the world. And the financial returns can be everything from full market rate risk adjusted to something less than that called concessionary returns. So I'm not a big fan of concessionary. I think people that do impact investing value a lot the social, environmental, and other benefits more than just the financial. They want to see double, triple, or quadruple bottom line returns. That's what makes it impact investing. You go to the next slide. Let me just also share that this thing called socially responsible investing is a broad category above impact investing. You'll see here on the slide just what's gone on in this space over the last 7 or 8, 9, 10 years here. Between 2012 and 2019, the social responsible investing market has grown from $3.75 trillion to $17.1 trillion in 2019. Huge growth. That's 24% compounded a year. I'll bet most of our friends out there in the audience would love to be investing in something that's generating 24%. Well, that's the growth in this market, SRIs. And impact investing is growing even faster, at 44 to 502 billion. Notice difference, trillions to billions here, $502 billion in 2019. And that growth rate's been 41% per year. So huge interest in how do we deploy capital to make a difference in the world, and the younger generation even more than those of us that have been around for a while.
Wow, yeah, I just want to say That's huge, and it reflects what I'm sort of hearing as I have conversations with people about social impact investing. You know, some financial professionals I've asked about it. I know I've asked, have you seen, you know, your clients express an interest? And a lot of times the answer is, well, you know, my younger clients or, you know, my kids are very interested. So it does certainly seem like, you know, we're on the brink of this new wave here. And, you know, getting ahead of it is, and getting ourselves educated ahead of it is important. And being a millennial myself, I'm very excited about it. So thank you, David.
Thanks, David. And that brings us to our first poll. We're going to be doing some polling during today's presentation. So our first question is, have you dabbled in ESG mutual funds? Yes or no? I'll close the poll out and share our results. It looks like the majority of us at 100% have not dabbled in ESG mutual funds. So it looks like a lot of us here today are looking to learn a little bit more. So with that, we'll keep the ball rolling.
All right. So now that we have a better understanding of impact investing itself, John, can you tell us a little bit about some of the myths versus facts? So, you know, word of mouth might be going around, and people might be saying things, you know, what's true, what's just hearsay as it relates to this?
Thank you. I'd like to thank you, Brittany, and the Next Generation Trust Company as well for hosting us today. And now to the myths and the reality. It's pretty interesting that nobody has done ESG investing through their brokerage account or through their IRAs, because it is one of the fastest growing asset classes in the world. And when you say that, you know, a lot of people don't get into it because they think that they're going to get a lower rate of return on their investments, which is totally a myth. Really, actually, according to the S&P, the S&P 500 ESG fund in the last 3 years have netted over 17%, whereas the S&P 500 has netted just a little bit over 16%. So as you can see, some of the ESG funds and ESG companies that are getting into environmentally, socially, and governance types of projects within their companies. And you probably are investing in some of those companies right now, like Microsoft is one of them, and Google and Amazon obviously is one of the ones because they are all over the place. Those are companies that are instituting ESG compliance within their own companies. Also, on the second side, if you're doing an alternative investment, you have the opportunity to make larger returns because you're going into maybe a startup company, maybe an opportunity zone investment, maybe a real estate investment. So these types of investments at times, you know, give large multiples if you do your homework properly and you want to follow the passion that you bring to that investment. And what's even better about impact investing is that when you're investing in an individual organization or an individual startup company, you get these reports from them on not only their social impact, but also on their financial impact. And when they hit a stumbling block, you as an expert, maybe in a certain field, can reach out to the owners because you have a vested interest in their success. Not only their success on a financial return, but also a success on their social return. So that is the double bottom line that you're really looking for when you get into the impact investment field. The second myth is that impact investing is you can't measure the sustainable investment. Well, there are ways to measure the impact that you're making, and more resources are becoming available every single day because this is a growing asset class, and transparency is the standard for all impact investing. And then thirdly, sustainable investing is a niche. It's a fad. Well, I don't believe in that, and either does GIIN, which is the Global Impact Investment Investing Network. And because why is so much money going into it if it's a fad? People don't, just put money into a fad and think that that it's going to go away over time. This is about patient dollars. So patient dollars are expecting a rate of return and an impact on the economy or on society over time. So if you're thinking that it's a fad and people put in $715 billion in 2020 into a fad investment that is supposed to be patient, it doesn't make, that is totally a myth. And then fourth one that I'm bringing up is that it's all about equities. Impact investing has many, many different asset classes. As I mentioned before, opportunity zones. You also have publicly traded debt. You have privately traded debt. You have publicly traded equity and private equity. So it's like you're able to dabble into the VC world or the lending world and really make a difference in the communities and within society just by getting involved with impact investing. And nobody's saying that you should take 100% of your money and throw it into impact investing. It is another asset class. It should be realized that it is a riskier asset class. So therefore, you have to look at your own
Risk appetite.
Yeah, risk appetite. Thank you, Dave. That's why I went to Rollins and he went to Harvard. Your own risk appetite to decide how much of that portfolio you really wish to invest in these types of assets.
Thanks, John. And yeah, I actually have to say that I found the statistics on private debt surprising, or I did not know that such a significant portion of this was attributed to that. I also mythically assumed that it was private equity. And to the point about it not being a fad, I'm by no means an expert on this, but also just thinking about the fact that as more time goes on, our world becomes just more interconnected than ever. With the use of technology, we're just so much more aware of and affected by what's happening everywhere that I can't imagine this would become something that we're not interested in as time goes on, or we're not impacted by as time goes on. So thank you for those insights and for the myth busting. Let's go over to David. So I think that people typically, when we talk about charitable giving and social causes, assume, okay, well then I just have to make a donation in order to give or in order to contribute to these things. So why would an investor use investment assets instead of going the traditional donation route?
Yeah, Brittany, it's a great question. It's almost one that we could put into the myth category too. People think, oh, well, I can give to do good and I'm just going to invest for great return. But if you look at the magnitude of the social causes that so many people care about, whether it's poverty that we'll spend more time looking at later, or the environment or education, and you look at this chart that I have displayed here, you'll see that all of the charitable giving per year, all of it in the US, averages about $450 billion. That's that one little green square in the upper left-hand chart. And the government helps with some of the things that we all care about. That's a couple of trillion, 4 trillion. But everybody here on this call is interested in IRAs, self-directed IRAs. What could I do with my IRA investments if I could align them to achieve purposes that I care about in any of the causes that are near and dear to each individual? There's $19 trillion there. And if people want to invest straight out of their investment wallets, there's a total, including IRAs, of $85 trillion. So for us as a society, as a world, to tackle the things that are most important, we need to find ways to get from the green to the purple and blue squares, because mobilizing that kind of capital can move the needle on the big issues that we'd all like to see made better.
Certainly, that visual puts everything in perspective.
Those purple squares are important. So thank you all that have IRAs.
That's what we're here.
And with that, we're on to our next poll. We would like to know, have you ever invested in a startup in a socially benefited company? So we'll launch that now, yes or no. Okay, looks like we're done there. And with that, we have 67% that said yes and 33% that said no. So we have a good mix. With that, I'll give it back to Brittany and on to our next question.
Thank you, Erica. All right, so getting a little bit more specific now, to each of you, David and John, and whoever would like to start is free. Can you each give us an example, a specific example of how others are using impact investing to align their investments with their values?
Yeah, Brittany, I'll tackle this one to start and then let John clean up here. One of the big issues in our world is just global poverty. And when you think about global poverty, it gets you to human trafficking, civil strife, refugee flight, lack of water, electricity, sanitation. There's just a lot of things that get wrapped up into that. And some of the people in the audience will know that the stats show 2 billion people living on less than $3 a day. And nobody that I know thinks that we can donate our way into solving global poverty. It just is not going to happen. There's not enough charitable dollars, as you saw on that prior slide. So let me just show the next slide, if you could, Erica. So let me just tackle one region of the world. It's one that we spend our time in, that's sub-Saharan Africa, where when I talk about the magnitude of the need and talking to investors, those with self-directed IRAs and others that say, how could I make a difference to try and make the world better in Africa? And I start with the fact that 450 million people are going to enter the workforce in the next 15 years. 450 million. The number of jobs that are likely to be created, according to all the gurus that look at this, that is about 100 billion. So 350 million people unemployed or underemployed. The only way people get jobs in our country and in the developing world at scale is through small, medium enterprises. These are companies that employ between 10 and 250 employees. Those are the job creation engines. And guess what? With a job, you have an income, with income savings, with income, kids in school, better water, better housing, access to electricity, those sorts of things. But in the developing world, capital doesn't flow because on a market base, the risk-adjusted market rate returns don't quite get there. So it takes this impact investing to figure out how do you go after that missing middle, the places where capital isn't there for those businessmen and women running companies that would employ people, but they need the capital to do so. The next slide, please. So when people say, David, I get the theory, talk to me in reality. What kind of companies are out there that Talenton has been able to find that we've been able to invest in a range of companies in our portfolio, from a specialty grade coffee company in Burundi employing 67 people full-time, hundreds of people seasonal part-time, to a chain of Montessori preschools in Nairobi. And I love the little the picture of the 11-year-old girl in that photo, the second one in from the left. She's now an author. So you get kids in school, they learn to read and write. She's created her own book. To Contegra, it's a organic pesticide company. I'll come back to that in a minute just to give you a little more detail on one of these companies. To a yogurt company in Rwanda, where they have 41 people, half of whom are deaf. Now, the employer there thought, oh, I'll be doing good by hiring deaf people. They're fabulous workers because nobody else in the country was hiring anybody with any kind of handicap. So he's hiring half of his staff are deaf, and everybody in the factory speaks sign language. That's a company already serving 2,000 farmers and looking to triple in the next couple of years. But I'll just sort of end my story and then pass to John with the biotechnology company. This company makes an organic pesticide. So for everybody in the world that cares about the environment, eating healthy, would like to be eating organic food, guess what? You need some way to treat the pests there, the organic pesticides. And the way that this pyrethrum processing works is smallholder farmers grow flowers, and every month they harvest the flowers. They cart them to collection stations, which take them to the factory. That factory turns it into organic pesticide that's sold all the world over. But guess what? Every farmer is paid $80 to $100 a month for an average crop. That's a minimum wage job in that part of our world. So for every acre that a farmer plants, they're getting the equivalent of a minimum wage job contributing to their family. We have some fabulous virtual reality videos to take people on tours to go see that kind of thing. All of these are impact investments that are there to try and tackle this one issue, global poverty. But you see, global poverty touches on so many other issues. And John, I know you have an example.
Yes, I do. So this is not a company that I'm very familiar with, but I looked it up, and it's about wealth inequality in our economy, and this is in the United States. And the reason that I picked this one was that a lot of people have another myth in their mind that impact investing is only for countries like Africa or in the Caribbean, Latin America, and around the world where there is so much poverty and so much pain being suffered by people. But here in our own country, access to capital is one of the largest problems or challenges that we face today. This is where, if you're a minority business owner, or if you're a woman business owner, or a minority woman business owner, you go to a VC company, you have a great idea, you have a great company, and the VC just looks at you as a person who did not have the same opportunities as white men like I have had in the past. And the reality is that 95% of VC dollars go to white men, and only 5% goes to the minorities. So if that's the problem, we could solve those problems here. Black Lives Matters is an issue. It's right in our face right now. And we need to invest in our communities here in the United States. And Start Co-op is an organization that helps economic inequality and brings business people together and co-op their businesses to help them become successful and also give them the access to capital that they need to create real societal change. Impact investing is probably the #1 way to do it. We as people helping other people, not just by giving money to a charity who is taking care of basic needs, which is definitely needed. I'm a philanthropic advisor. I talk to people about how to leave legacies in charitable giving and passing their values on to their children. But also, when you use your investable dollars to rebuild communities, to help people get out of their own way, to have them be able to control their own destiny, rather than being laid off 3 times in 20 years because of things that never really had anything to do with them, whether it was the 2000 debacle in the stock market, and then we had the financial, and now we have COVID. The same people have no way of getting ahead if they keep getting pushed back. We need to help people grow the economy. Small business is the backbone of our world, and impact investment helps small business.
Thank you, David and John, for those examples. I think it helps our audience also to see, and those who are maybe not as familiar, to see that there's so many opportunities out there to contribute and get involved in different ways. And, you know, these things that we can have an influence on, or investors can have an influence on, impact not just those directly that are, you know, suffering, but everybody at the end of the day. And, you know, there are things, there's something out there for everyone that I can imagine someone feels, you know, whether through their personal experience or someone they know that they feel very passionately about. So it seems that there's no shortage of opportunity to get involved in something out there. So thank you for sharing the examples.
And Brittany, let me see if we can turn the question back to you. Every person that I meet with has an IRA, as we saw from one of those earlier charts. But whenever I say, well, you know, one of the options is to use a self-directed IRA, they frequently haven't heard about that. So what is a self-directed IRA?
Well, funny you should ask.
You have
Your Carnac, you got the envelope.
I'll take it. So it is important to spend a minute really defining the term, because sometimes this term is used in different ways in the industry as well. Sometimes individuals who we speak with initially say, well, self-directed IRA, I have one of those at Schwab, or I have one of those at Fidelity. So why do I need to talk to you? And there's a difference between the term used to refer to the fact that you could have an IRA that allows you to invest in public securities, but is called a self-directed IRA in the sense that you have the ability to choose the securities that you want to hold. Versus what we're talking about here today is a deeper level and a deeper distinction, meaning that, as Erica had alluded to at the beginning of our conversation, we're talking here when we mention self-directed IRA as a vehicle that is not limiting you to public securities, rather opening up your allowable options to include non-publicly traded alternatives. And that's where usually people kind of perk up, like, wait a minute, really? I didn't know I could do that with my IRA. So then the question sort of becomes like, okay, I start thinking, why would I want to do this? It makes sense that I have the option, but then, okay, how does this benefit me, and why should I do anything differently than what I'm already doing? So there are a few perks to considering self-direction, and obviously it's not meant to replace investing in stocks and bonds by any means. You know, it's certainly important to be invested in the market. It can be very beneficial in cases, but rather by investing in these types of assets through an IRA, rather than using personal funds, for one, you may have more opportunity to invest more money. As David, as you had said, there's a ton of money tied up in retirement accounts. Not everybody has that in their checking or savings available to deploy. So this gives you a resource to potentially pull more to invest in those types of things. It's also going to give you potentially some diversification or a hedge against volatility. Alternative assets tend to be non-correlated with the stock market. So over long periods of time, if the market is, you know, fluctuating or market has a downturn, those alternatives tend to be more stable. So there's that as well. And then of course, there's also, to the investors themselves, that tax benefit. So if you were to invest using your personal funds, you earn money on that investment. Whether or not you plan to use those funds now, you still are responsible for paying tax on them now. When you're using an IRA as a vehicle for that, what you're doing is you're sheltering your gains from that tax responsibility, at least as long as it's in your retirement account. So if you have a tax deferred plan, your earnings are going to be deferred as long as you want to keep them in that account. If you're using a Roth IRA, which is a beautiful option if it's possible for the investor, then that is going to earn tax-free returns. So, I mean, there's no other way that you could not have to pay taxes on gains like that other than doing it through a Roth IRA or an IRA. So really, that's how we would define, you know, the self-directed IRA and what really distinguishes it, as well as having the ability to, lastly, I would just say, ability to control your return on investment a bit more by having, as John said, that freedom, right, to control your own destiny, that freedom to accelerate your wealth rather than just investing in, you know, a large public company and crossing your fingers nobody tweets the wrong thing and, you know, stock plummets tomorrow. So there's a lot more involvement by the investor and a lot more freedom to have influence over the returns as well.
Great. What types of investments are allowed in self-directed IRAs other than impact investments, what we've been talking about here today?
Sure. So actually, some of these things could fall, and some of these could fall within impact investing as sort of even an overarching category. But generally speaking, the IRS really only has laid out what you can't invest in with a self-directed IRA. So they exclude life insurance and they exclude collectibles or antiques. But just about anything else that's not publicly traded is game for consideration. So with that, real estate, as you can imagine, is you know, makes up the lion's share of asset classes in self-directed IRAs, at least today. A close second, I would say, is private equity. So investing in private companies, startups, private stock, even pre-IPO companies. Lending would be a third. So any private lending of any type, whether it's for real estate purposes or just even personal, for someone's personal use out of an IRA, that is another common thing that we see, as well as hedge funds, domestic or offshore, precious metals as well, and then partnerships that can be formed with an IRA as one partner or multiple IRAs as multiple partners, along with other individuals. So there are a lot of different options in terms of kind of getting creative and pooling funds and utilizing IRA funds to do various investments here.
Thanks, Britt. On to our next poll. We'd like to know if you have ever used a self-directed IRA to invest in any of these investments, or if there's any that you might be interested in using a self-directed IRA for. So we're going to launch that poll now. Okay, I will close that one out. Share the results, and it looks like the majority of us are either already invested in or interested in investing in social causes and impact investments. So obviously you guys are here today for a reason, and that would be it. So with that, back to you, Britt.
So Britt, let me ask you a couple of questions, if I may.
Sure.
Some of the myths about self-directed IRAs, and are there any restrictions on a self-directed IRA?
So let's start with myths. The first one we tend to hear a lot is that, oh, I don't have, you know, I'm not a millionaire, I don't have $1 million in my IRA, so what can I really do? It used to be, I think the perception was that self-directed IRAs were only for the very wealthy, and I think that today this is much more mainstream and widely accepted, and it certainly is possible to be successful using a self-directed IRA, you know, even with 5 figures or even maybe even less than that to start. So there's no minimum required with a self-directed IRA, and depending on what it is that you're looking to do, if the investment required is not, you know, substantial, or it's not unreasonable for you, then you can certainly, you know, get creative and do some, you know, maybe smaller investments with a self-directed IRA. As long as you qualify to have an IRA, you can certainly set one up and you can be successful. I think it's just key that anyone doing this is educating and taking the time to educate themselves to understand the guidelines, the process, and the rules and regulations, which I'll talk about in a few minutes on the rules. But the second misconception, I think, also is that a self-directed IRA is like a type of IRA. And while it's defined as the ability to invest in non-public alternatives, as I had mentioned, still even within that space, each investor has the ability to choose an account type, whether it be like your traditional tax-deferred IRA, as I mentioned before, your Roth. You could have a self-directed SEP or simple or solo 401k if you're a business owner, and those are going to just give investors the opportunities to choose which account setup is best for them. They can do any of the alternative investments within any of those account types, but when it comes to looking at things like your contribution limits and how the accounts are treated from a tax perspective, then it just comes down to a matter of what's the best fit for each investor. But I think it's important to clarify that there are different account types that can be self-directed as well. And then this one I've heard a lot as well. When we talk about contribution limits, the IRS allows each individual to deposit up to a certain amount of their own personal funds each year into an IRA. And those amounts vary depending on the account type. When we talk about self-directed IRAs and using them to invest in different companies and accelerating earnings, sometimes we will get the question, well, what if I make too much money in my self-directed IRA? Am I going to exceed those contribution limits? And to clarify, when we talk about investment earnings in a self-directed IRA, we're talking about something completely different than what you're contributing out of your own pocket. So with the self-directed IRA, you can make a contribution out of pocket, you can invest the cash in your IRA, and there's no limit to what you can earn. So when you already have cash in your IRA and you put that into an investment, and that yields some return, that can be as great as, it's as great as possible, as great as you're able to see. So there's no limit to what you can earn and how quickly you can grow the account. It's really just about making the investments that work for you and that you feel comfortable and confident about.
If I may interject also, when you did say that it's not only for the wealthy, you could dabble into social impact investing. Everyone's aware of crowdfunding platforms and things to that nature, so like Kickstarter. But we have companies that are on the WeFunder platform or the Start Engine platform, Kiva, and the minimums are just $100. So you could dabble in social impact investing with as little as $100. Now there are funds that may have minimums, and you maybe have to be an accredited investor to get involved with those other types of funds. But it's not hard to get involved. It's very simple. Find out something that you're passionate about, do a little bit of research, reach out to an expert that's in the field, and we'll help you decide where you want to invest your dollars.
Great. Thanks, John. So to answer the second part of your question about are there any restrictions? Yes, there are. The friendly IRS does have rules. So when we're working with tax advantage accounts, the reason it's important to be educated is because there are certain things that we're not permitted to do with those IRAs. And the IRS defines these as what they call prohibited transactions. So they define that as any transaction between an IRA and what they call a disqualified person. So Erica, if you could just skip ahead real quick, I'll talk about disqualified persons and we'll come back to this. So disqualified persons would include any individuals that fit this relationship to the IRA. So if you have a self-directed IRA, you're the IRA holder, so you yourself are considered a disqualified person from your own IRA, meaning that you can't directly invest or do a transaction with your IRA. For example, selling something to yourself from your IRA or using your IRA to, lend to yourself or vice versa. Same thing with any spouse, ascendants, descendants, or their spouses. So if you think about the family tree and sort of like a lineal direction, any of those relationships are considered disqualified from transacting with the self-directed IRA. as well as any financial professionals that are providing a service to the account, which could present a conflict of interest. So when we think about those relationships, these are the, if you have an investment in mind, these are the individuals that would not be able to do a direct investment with the self-directed IRA. So if we skip back for a moment, there are 3 types of prohibited transactions. And I just gave sort of an example actually of this first one, an IRA engaging in a transaction directly with a disqualified person. So that, again, that would be selling anything to or buying anything from, even if it's the IRA purchases something and then a disqualified person tries to add cash into that investment or for the IRA to further contribute to the investment, that's not an option. Same thing with extending any credit. So lending, as I had mentioned, IRA cannot lend to a disqualified person, nor can there be an extension of credit between an IRA and a disqualified person. So that could be guaranteeing a loan, for example, not permitted with a self-directed IRA. And then the third type is a little bit more of a gray area, but self-dealing typically refers to the idea that an IRA's investment is somehow benefiting a disqualified person. While it might not be direct financial benefit, there could be some other benefit that comes to a disqualified person as a result of the IRA's investment. So, for example, someone might use their self-directed IRA to invest in a company, and then the company might say, because you did this investment, John Smith, we are also going to allow you personally to purchase this other stock that we have only available specifically for individuals that have, done this investment with us. So sort of offering it as like an exclusive opportunity because the IRA did its investment. So something like that would not be allowed. Now you can see why this could become more gray area and get a little bit more complicated. And this is usually where IRA custodian comes in to review the particulars of the scenario and makes a determination as to whether or not that investment could be held in a self-directed IRA. So when it comes to impact investing, I don't really see this as being much an issue because I think most often those individuals that are investing with their IRAs don't own those organizations or not, they're not holding, high positions in those funds where they would have a ton of control. Usually it tends to be more of a passive investment. I don't know, David or John, if you have any commentary on that.
Yeah, Brittany, it only came into play for us is that none of us that are in the management team at Talenton could invest in our own fund out of our IRAs. Exactly. I've invested personally, but I couldn't use my IRA funds to invest in our fund for this exact reason, what you've just described.
Exactly. Yeah. Yeah. So that's sort of, this is why we provide the education so that individuals are just aware of, the boundaries and comfortable getting into this, knowing that, what they're looking to do would not be a deal breaker, for example.
Maybe just any timelines that investors should be aware of when they're considering a self-directed IRA?
I think it's important that this is part of an upfront discussion. And I know David and you and I have had conversations about this too. This tends to be sometimes come as a surprise to new investors using IRAs who are typically familiar with the traditional model of, trading stocks and bonds with a brokerage account. Because those assets are publicly traded, it's a lot easier to press a button, for example, and sell stock or buy, right? Using, your phone or, just going online and just pressing a button and a transaction is done in real time. The business model for working with alternative assets and IRAs, at least today, that business model is a bit different and it involves more steps in the process because these assets are not publicly traded. So typically the first step in the process to get started using a self-directed IRA would be to create an account. set up a new IRA held by a self-directed IRA custodian. And upon submitting an application, it takes about 1 to 2 days typically for that to be established. Funding the account can be done, as I mentioned earlier, by making a contribution or transferring some funds from another IRA that will not hold alternatives, or rolling over from an old employer plan, like a 401k, for example, into that self-directed IRA. So those are all options, but the time frame widely varies depending on the other institutions' processing times and their requirements for clearing the funds out of their custody. But that is a process that we work with hand in hand through with our investors. And then lastly, the investment itself, making an investment in, for example, doing impact investing, would require us to see some supporting documentation for that fund or that company. And then it would also require the IRA holder to complete and submit some internal documentation for us as custodian, for example, to review as a direction of investment, because this is self-directed. So the account holder would be telling their custodian, I'd like to invest X thousand dollars in ABC company or fund. I would like the money wired to this account. So it's all direction provided to us that we would execute based on account holders' wishes. And of course, part of that's going to require a review of the documentation from a compliance perspective and feasibility perspective. So the custodian will do that, which typically takes several business days. So all in all, prior to, from start to finish, we typically suggest that there be a 4 to 6 week time frame up front for someone to reach out to us to kind of get educated, get started, get the account open, funded, transaction process. Now, of course, if there's already an account set up and funded, if they've already done an investment prior and they're just doing a new one, that time frame can be shortened. But it's certainly important to be aware that, yes, it takes several weeks most likely, and that there should be conversation had up front, and it's important to set those expectations not only with investors but with the companies that they're investing in as well, the sponsors of these investments, so that everyone's working together efficiently.
I'm just going to say that we had a client that wanted to invest in us and used NextGen to do so in this last month, and they were handled very, very well, and everything went super smooth in the whole process. So kudos, Brittany, to you and Erica and your operations team for the way they handled our joint client in this instance.
We're glad to hear that. Thanks, David.
And with that, we've finished up our presentation. We're going to move into Q&A, but it looks like we don't have any questions from our audience. So hopefully you guys were able to, really get the most out of the conversation today. But before we wrap up, I did have a poll that we didn't get out earlier. But this is obviously the most opportune moment. So with that said, if you had access to an infinite amount of dollars, so let's say your funds are uncapped, what type of impact investing would you want to invest in? So we'll launch that now. And just to let you guys know, this is multi-select, so we'll probably have some percentages here and there, but we'll just wait for the rest of those to come in. Give it a couple more seconds. I'll close that out now and share the results. So it looks like the majority of us are interested in or would be passionate about poverty, hunger, homelessness, followed by health and well-being, which could include clean water and sanitation, followed by environmental. Sorry, there was a typo there. That would include anything like affordable or clean energy. And then the other options were governmental, which would include quality education or economic growth, and equality, which would include any causes surrounding gender, sexuality, or race. So that's that. And with that being said, we have our contact info if you'd like to get in touch with us. Our website has a plethora of resources for education. We have an extensive webinar library. As I said earlier today, all of our webinars are recorded and available for on demand. So all of those are available on our website. We have a newsletter that you can sign up for to stay in touch with us. You can subscribe to our blog for bi-weekly updates, and tons of other resources. So if you'd like to get in contact with us, here's our information. And if you'd like to get in contact with John or David, here's theirs. And I'll let you guys wrap it up.
Excellent. Well, I just want to thank you both again, David and John, for your insights and your expertise. I think, again, I'll just reiterate, I just think that this is a really important topic. And I hope that we've been able to teach our listeners something valuable or something, for further consideration. And we're certainly, all of us are available for further conversation or questions as they might come up in the future. David and John, any closing comments from you?
I just want to say thank you to Brittany and Erica and your team. Thanks for giving us a chance to educate new folks to learn about impact investing. It's been a lot of fun, I know, for John and for me to work with you guys to do this. So thank you, and thank the audience for your interest in this topic.
And I'll ditto that.
Perfect.
All righty,
All right.
with that being said, that concludes today's webinar. Thank you everyone for joining, and we'll see you on the next one.
God
Take
bless.
care, everyone. Bye.